Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International, Bill Spindle, Senior Global Correspondent at Cipher News, and Laurie Haytan, MENA Director at Natural Resources Governance Institute. Thanks so much, everyone, for joining us. Medlin, if we could have the results of those couple of survey questions we've had this week, I just wanted to go to Laurie for first comments about OPEC, really, and what it might be facing. At its meeting later this month. It's obviously, trying to fight the tide, if you like, of the current market, which seems to be that supply is dampening any effort to try and keep this price above $80, or sentiment perhaps is dampening that. So, Laurie, what do you think they're likely to do? I mean, this week the conversation has turned to not will they extend, but will they have to cut more in the first quarter? And do you think they'll do that, or wait it out a bit more?
We started with the hard question of guessing what OPEC and OPEC Plus and Saudi Arabia want to do. I think there is what Saudi Arabia wants to do and can do, and there is OPEC, what they can do and want to do, and there is OPEC Plus, what they can do and what to do. So if you can align all of these, you can have a decision. If you cannot align all the incentives you might have individual decisions, and the way that we have seen so far from the Saudis. So again, based on what Saudis say, that they look at the market and not at how they want to see the price of oil based on their economy. It seems like the economy worldwide is not going well. We were all waiting for China's recovery for months and months. We said about the second quarter, the third quarter, the fourth quarter, the second half of the year, all of that, and it didn't come. And now people are speaking about recession in OECD countries, in Europe, even when they were saying that the US is doing fine. Now there is talk of that. All of that is not good news. So that they will take into consideration that, and looking at the fact that there is a war in the region and it didn't affect much the prices. So looking into that, they will look into all these factors, and I think they will decide on what decision they will take.
Okay, I mean, Mark, let's just take one point there that Laurie mentioned, which is about the sort of economic situation of the world, if you like. I mean, we have, obviously people, as we've approached the end of this year, have accepted that we haven't seen, even a shallow recession in the US yet. We have seen, obviously, that in Europe. But what is the sentiment as we get to the end of the year with what we're expecting from the US economy, from China economy, from Europe next year? I mean, is it going to be more or less a balanced picture as we saw this year, or another year of two halves, or where do you see things falling right now?
Well, I think there's two different things here. There's what the market wants, which is particularly the financial markets rather than the energy market, which is, as ever, willful, full of wishful seeing, full of willful blindness. They've been on the wrong narrative on recession for 14 months, 15 months. So we'll probably have to give Mr. Market, a 2 out of 10 for their view on the global economy so far. In terms of, elsewhere, I think most people should probably remain fairly agnostic. I think that the situation is that, whatever recession we might have, and it looks very likely in Europe and the UK, is likely to be a shallow one. The US is going to slow markedly in the fourth quarter of this year. I mean, let's make no mistake about that. Household savings have been run down. There are additional costs. Particularly things like insurance sectors, the costs have gone up, particularly for US households. China is sort of a case in point, because I think that the relevance of China going into recession or not is not, this year has proved to be something of a spurious discussion. The fact of the matter is Chinese oil demand has held up really well this year, and that's reflective to me largely of the fact that refining capacity elsewhere has been run down so badly, and China and also India and indeed GCC countries have basically stolen the march in terms of refining capacity. So we've got we then turn the story into crude and product demand. Product demand, I think, is probably where the weakness will be. but it's not going to be the sort of level of weakness that demands a $10-15 fall in oil prices. The problem is what we've got at the moment with these very sharp moves in oil prices is the evidence that underlying liquidity, not only in the energy market, but also in equity markets and bond markets, is really very, very poor. And I think it's going to stay poor through to January.
Okay, but Bill, morning again. Let's just go on that point of sort of oil prices and why, we've seen them, drop. I mean, I suppose they stabilize a little bit in the last week or two. Again, from the sort of OPEC angle, but again, more from the sort of revenue angle for the Gulf economies, let's say, do you think there's some concern building up there that, Saudi's been taking all the brunt, doing all the voluntary cuts, really? There was a comment yesterday on the podcast that, if they're going to cut more volumes, then really others are going to have to join that bandwagon. Do you agree with that, or do you think Saudi can continue to hold that mantle if we need to go further?
Well, I think Saudi is in something of a bind. It as it cuts production, it is definitely hitting its economy. You saw that in the last quarter, and yet there really is no other leader in OPEC. The UAE is planning on actually increasing production early next year. Others are simply, way below their quotas. They're not in any position to carry the weight. So at the end of the day, I think it really does fall on Saudi, but they're in a tough spot because they increasingly have a lot of expenditures at home as part of their big Vision 2030 diversification plan, and they need that money. But at the same time, there really is no other, leadership in OPEC to do it.
Okay, Laurie, just back to you on the sort of the security concerns, let's say, around the conflict in the region. And we did have an incident this week with a purported attack or by the Houthis in the Red Sea on an Israeli vessel. The first evidence that we've seen a bit of physical activity, if you like, maritime security, perhaps resulting from what we're seeing being done in Gaza. So any thoughts there on where that sort of risk premium is going? As you said earlier, that's been dropping, and OPEC has seen that happen in terms of price impact. But I mean, where are we at in terms of sentiment where we could possibly see a threat to oil supplies if this escalates any further, or if it isn't resolved?
Look, that capture of the vessel by the Houthis is something to be worried about, and to see how they will continue or escalate in that matter. Because what they've tried to do, the Houthis, at least from where they're standing and geographically, and threatening Israel on the Red Sea. And as you know, they were rockets fired by the Houthis, intercepted by the Saudis in the Red Sea. And the Red Sea is very sensitive. So they were trying to reach Eilat. Eilat was one of the three main ports of Israel where it gets imports and exports, definitely. But lately they were getting, when they closed Ashkelon, which was under the threat of Hamas, so they were diverting all the commerce was going into Eilat, at least for their imports of oil and oil products. So, but again, it's not only about Israel itself being like all its ports being under the attack of Hamas or the Houthis or Hezbollah and Haifa, which Hezbollah didn't attack yet or didn't announce any intention to attack. But it's not only a story of Israel's economy, because the Red Sea, as you know, is very important for the Saudis, and it's very important for the Egyptians as well. And NEOM is on that Red Sea, and all the security around that, and all the potential that NEOM has, and all the vision is built on NEOM. So seeing that there are attacks like Bab el-Mandab becoming like very sensitive in the hands of Houthis, that they can take things into matter, does mean a lot. And it will be something that they will look into it. But again, what we were saying, and what was said at least in the podcast by many other experts, that maybe the Israel-Palestine war didn't have a big effect on oil and gas, but there are these kind of things like physical attacks on boats, on ships, etc. So now it is like just a commercial ship, but who says that it won't escalate if the war continues escalating into physical attacks, into more than just commercial ships, more into like tankers, etc. So that would be really something that will scare the market, of course, and that bring the prices up.
Yeah, yeah. Mark, let's just talk a bit about, again, so back to economy, but more specifically about Fed and Fed policy. There does seem to be 2 points of view at the moment in the markets that, the Fed is done, but it's sort of higher for longer, but where we're at. And others say, no, actually, we're definitely going to see a cut in rates next year as we see the sort of recessionary signals strengthen, if you like, in the US economy. Is the Fed stuck between a rock and a hard place? I mean, what can it do next? Do you think it's just going to hold its ground? Inflation is coming down, but not quite to where we want it. What's the likely scenario next year on that front?
I think, personally, I don't think the Fed's going to be cutting before the second half of next year. Much depends on the evolution of core inflation in the States, which has remained stubborn. It also remains stubborn in UK, in Japan, in Eurozone. And that's going to be important because it is where real rates are, and markets have not done themselves actually a big favor here with the rally in bonds of late. It's where real rates are that's going to matter to the Fed most. Thus, if we see inflation getting back, particularly core inflation, back to 2.5%, then that would, we've got, the Fed funds rate still at 5.25%, 5.5%, then the Fed will basically say we've got room to cut because they don't want to see real inflation, real interest rates much above 2%. They consider 2% to be sufficiently restrictive, and that's the metric. Markets obviously wanted to know all about timing, but when? It's always when. It's going to be when the inflation metric meets that particular calculation, and that's difficult to predict, particularly with the volatility that we're seeing in energy prices.
Yeah, and I suppose, we've got to accept that the Fed has become, OPEC has become like the Fed, or Fed has become like OPEC, when, be patient, we'll tell you 1 month at a time, stop trying to predict too much into the future, specifically with all these variables that are quite unique. Bill, let's talk a bit about COP28. That's coming up in less than 10 days' time, starting here in the UAE, hosted here at the UAE. We had a headline on the bulletin today about expectations around COP from the oil and gas sector. But generally speaking, what do you expect the UAE as a host to deliver at the end of it? Are we going to have a more successful COP than the last two that we've seen in terms of more concrete, actionable points, or just more of the same?
Well, I think, the UAE will be managing two really big underlying tensions. One is between the global stock take, which is going to, obviously show that the world is way, way further behind than before, even in terms of fighting climate change, balanced against, the real reluctance to opposition from many to some sort of a phase down in fossil fuels or a phase out in fossil fuels. That's one big tension. The other one is going to be sort of global north, global south in terms of financing. Those two things are kind of related. In a sense, those are both unresolvable, huge issues that are not going to get resolved in any final way, for sure. But I do think there's ways to deliver something that'll look successful, and I think that really comes down to a significant renewables pledge. This is the tripling of renewable energy. If the UAE can push that through in conjunction with a financing package of, both funds, but also reforms to the global multilateral banking system, other things, some sort of a financing package that looks capable of delivering that tripling of renewables. So those are two big things that it could come through on. And then I think really the other thing is methane. That is probably the single thing that the oil and gas industry could do to give itself some actual credibility, is to come up with some sort of pretty solid agreement on methane. There's been some progress on that front. China mentioned methane, didn't set any goals, but for the first time, it's sort of addressing methane. And I think that generally the oil and gas industry is coming around to the view that there's really no escaping accountability for a lot of this, given a lot of new technologies and regulations that are in place.
And would you be in the camp of the sort of geopolitical situation between Russia, Ukraine, and now of course in the region, and what that could possibly lead to? Do you think that has accelerated or decelerated the energy transition expenditure and momentum? You've got two sides of the camp there, haven't you? People saying that, oh, energy security is now up front and center, so forget the transition for now, and others are saying no, it's taught us that we've got to speed this up, the transition. So where do you think the reality lies there in terms of expenditure?
I think the reality actually is not quite as stark a contrast as it appears at first. I think the reaction, certainly in Europe and many other places, has been to China as well, is to boost renewable energy and move the energy transition forward, at least from the renewable side, and alternatives to more volatile fossil fuels, to move that forward as fast as possible, while at the same time emphasizing that energy security requires a lot of reserves of fossil fuels. So you see a situation like in China where coal plants are being approved kind of by the dozen almost, and yet renewable energy, particularly solar, but also wind and nuclear, are hitting just absolutely eye-popping records every year. And that's really that both things are happening at once, right? They're saying we want the coal capacity there to use if we need it for security, but at the same time, we're going to build on our renewables as fast as we can possibly build them too. And that's kind of going to be the balance going forward. And to bring that back to COP, that's where this renewable energy pledge, I think, could probably get some traction, whereas some sort of a phase out on fossil fuels or a phase down on fossil fuels, that'll dominate the debate, but clearly there's not going to be any agreement on that.
Yeah. And of course, China's other big push is on EVs, isn't it? It's sort of multiplying its electric vehicle. Laurie, I mean, you're like Mark, based in Europe. Again, what is the expectation from COP, from the European sort of country momentum, commitment? Europe has been ahead of the curve and ahead of the game in terms of pushing transition, but of course, it's been most impacted by the Russia-Ukraine situation from an energy security point of view. So, where's Europe's head at, if you like, in that conversation?
Yeah, definitely. As you said, like Europe was really big on energy transition, and they are still big on energy transition. And for them, supported by the IEA documents and reports, etc., it was like, no, this energy security problem has put more emphasis on energy transition, and especially on renewables, because they felt that this is their to break with the dependence on Russian gas or any kind of energy. It's like for people to push for energy transition. And that had been a lot of talk last year, and since the Ukraine war had started, pushing for that. So, but at the same time, like member states and the EU had to take action like for short term. So Italy had to go to Algeria and sign deals with Algerians, with the Libyans for gas. But these are like the short term, let's say until 2030, if we want to talk about short term for Europe. But the longer term is like to continue and to push. And basically what we're having today is like you have one camp that is pushing about like the need to phase out from fossil fuel, and on the other side, this energy crisis and the Ukraine-Russia crisis had brought back the people, the energy people, to say that yes, we understand about it, and we acknowledge that there is energy transition that is happening. We're not sure it's happening in the same pace that Europe thinks it is happening. Maybe, yes, there is a plateau that is coming to come with peak demand in oil, in gas, etc. But it doesn't mean that plateau, that after that there is like this very, very fast decrease. It could stay for 30 years, etc. They don't see a change in the system. So, and this is what is happening. And this is what is going again to go to COP28, with people saying that you cannot only focus on decarbonizing the oil and gas sector, especially. You cannot only work on cutting emissions, on technologies, on CCUS, etc. You need to have commitments on really cutting fossil fuel production. And the other camp is saying, as long as the system is not set yet, and as long as we see demand and demand growing, so we need to for the safety and security of the world, we need to keep on producing, but we do understand what we need to put a lot of money on new technologies, etc. And there was a Rystad report yesterday that says if you want to reach 1.6, so Rystad is always like very realistic. They don't even speak about the 1.5. They're saying if you want to reach 1.6, we can do it because the 12 technologies that they assessed, they said they have potential, which means there's a lot of money that needs to be put there. And the Saudis and the UAE in the MENA have the means. They are the only two countries that have the financial means to really invest in these new technologies to advance the energy transition, at least in our region, in the MENA region. So I'm happy that I will be in COP28 this year, and hopefully we can discuss all of these in person. And whoever is there, I'll be very happy to meet as well the first week.
Yeah, we look forward to seeing you there. No, absolutely, it's going to be a very interesting meeting. Mark, you mentioned about China demand, and that at the beginning that we're talking about how that is now superseding the price activity. I was just about to ask you about China. So our survey questions just gone up. It's left it too little, too late, or too late for any more boost in government expenditure to bring back consumer confidence next year. Agree or disagree? So China has been obviously committing some funds to try, and it's done a few changes in its real estate policy and trying to sort of ease that situation. But is it too late for it to sort of spend its way out of the crisis? Demand has been healthy, Mark. You said it's been not bad coming from China. But what about what's still to come? It has some really deep economic problems, doesn't it, in terms of sectors?
It has some deep debt problems. So does the rest of the world. I think if we go back to COP28 just briefly, I think if the whole group actually committed to making sure we have the capacity in renewables before they start setting targets for cutting hydrocarbon output, we might be actually on a more constructive path, because without that increase in renewables capacity, we're not going anywhere. But that's by the by. As for China, they are doing precisely that. They are building out their capacity. This is the whole point when we're watching and marveling at the fact that they are world leaders in renewables technology. It's because they have realized that that's what needs to be done. But for the broader economy, yes, the property sector remains an eyesore, and the property sector is so interlinked with the banking sector, and they've got a lot of government debt. Will spending more? It's not about spending. Well, to a certain extent, it's about spending. It's about resolving this issue of the fact that the property sector's balance sheet is so appalling, and the impact on the banking sector is obviously a huge. They're having to do write-downs, loan loss provisions for all of this, and of course, some people will question whether it's actually open and honest. That's a little bit by the by. Until they actually start resolving those balance sheet problems, there's not going to be a lot of confidence. I just can't see it. But before they provide incentives to boost consumer purchases, particularly of property and indeed businesses, they need to resolve those problems, because without that, everyone's going to say, yes, but what am I actually buying into here? Because there's enough properties which have been sold off plan in China and are not happening. And that really undermines confidence.
Yeah, I suppose they've got to convince everybody and get that confidence back, if you like, into the economy. So it's a work in progress. Bill, in terms of the outlook for China as a demand center, I mean, and from the Gulf economy and Gulf producers' point of view, and we've seen obviously the divergence in these demand projections between OPEC and IEA, etc., talking their own book, perhaps all of them. But should Gulf producers be nervous about that? Should they be nervous also about the non-OPEC supply that has increasingly come on stream this year and is set to continue next year?
Yeah, I think China, the dilemma there is really comes down to what extent are they going to push forward with kind of rebalancing their whole economy towards a more consumer spending thing. And that is a long-term project that in the short term really requires pulling back and not doing the sort of traditional blowout, government infrastructure spending type of stimulus. So I think that's really the balance they continue to have to draw, is to what extent are we pushing forward with this rebalancing, which is where they still seem to be putting the emphasis. That's why they're reluctant to put together another gargantuan infrastructure package. So I think they're pretty clear they're going to forge ahead with that. And I think that's going to be a drag on Chinese growth going forward for quite a number of years, really. And they'll have to balance that against, just how much do they want growth, or are willing to let growth sort of tail off. So that's going to have implications over a longer term.
But they're also, in a way, counterintuitively cracking down on the new sector of the economy, the tech, getting too big, other sort of companies that they feel they want to, kind of keep under control. So they kind of shoot themselves in the foot, trying to sort of make this transition in their economy while clamping down on anyone who's getting too big. That's the survey result for now. Agree, disagree. That's pretty close. 56% say it's probably too late for it to bring back consumer confidence as soon as 2024. 44% disagree. Laurie, let me just go to you back to sort of not geopolitics but sanctions. Let's just talk a little bit about that to close off today. We saw some talk and reports that they're going to get more stringent on sanctioning Russian oil in the Danish Straits, and whether that's going to make any difference to the market. We've also had the US the last couple of weeks, talking about getting strict about Iranian oil flows, which it's let go for a while to China specifically. So do you see those threats, if you like, really coming true, and will it make any difference to the actual oil flowing?
So I don't think they will come true. And on top of that, today the Iranian Minister of Oil announced that by March 2024, their production will reach 3.6 million barrels per day. So it will come true or not, I don't know. But I think what we are seeing that today Iran is really playing for the future of its economy by not entering into the war and by not letting Hezbollah go into an escalation more than what is happening on the borders between Israel and Lebanon. And this, the Americans will really not forget it for them. And then, so they are buying their future today by the position they are sitting there. So they don't take this this talk about like sanctioning again Iranians, etc. They understand that this is in the public, and there's something. And the closer we get to 2024 and the elections in the States, everything will be in the hands of elections. But I think that at least from the Iranian side, they feel that today they are buying their future, and they see it like a good one without sanctions because of their position in the war. On Russia, I guess like nothing much to say. I've been more focusing on the Middle East and what was happening than on Russia. But I think like for Europe today, they're like now more focused on getting through winter, and then less talking about like if there is flow of money going into the coffers of the Ukrainian of the Russians, etc. So they're more preoccupied about their internal stuff, and they have elections as well soon next year.
Everybody has elections, so that's going to take precedence on everyone's priorities. Thanks so much, Laurie. Thank you again to Mark and Bill for joining us this morning, and have a great day, everyone. Great to see you.
Thank you.
Bye-bye.